Thanks everyone for joining us. And just some quick introductions. So we have Kimberly Ann, founder, director, CEO, and president at Lahontan Gold. We have Alison Turner, portfolio manager of Umbono Global Mining Fund, LLC at VSA Capital. We have Ian Williams, CEO at Charteris Treasury Portfolio Managers. Angelos, Damaskos, CEO at Sector Investment Managers. And finally, Luke Alexander, President, CEO, and Director at Newcore Gold. So thanks everyone for joining me today. Maybe to start, we can just do a quick 1-2 minute introduction to each of you, and then we can get into the questions. So Kimberly.
Hi, everyone. I'm Kimberly Ann. I'm the CEO and founder of Lahontan Gold Corp. We have assets in the Walker Land of Nevada. We're focused on fast-tracking our asset to production by next year. So it's a very exciting time for our company.
Thanks.
Hi, and I'm Alison Turner, and I manage a small long-short equity hedge fund, which is focused on the mining sector, not just precious metals, but kind of across the board.
My name is Ian Williams. I run the Charteris Gold and Precious Metals Fund, which I think amongst its UK peers has the highest exposure to silver miners relative to gold miners.
Good morning, Angelos, Damaskos, Sector Investment Managers. We are a natural resources focused investment management firm, splitting our allocation between oil and gas and mining, primarily focusing on precious metals, gold and silver mining, as well as some exposure to base metals such as copper, nickel, etc.
Luke Alexander, President and CEO of Newcore Gold. We're advancing the Enchi project in Ghana. It's a district-scale exploration project that's fundamentally underpinned by a very robust PEA that we put out a couple weeks ago. I guess my background, 20 years on the investment banking side of the business, 12 years here in London, covering all the big global natural resource funds, advising ASX, TSX, London-listed companies, and looking forward to the discussion today.
All right. Thanks, everyone. And so if you've been sitting in on my panels over the past 2 days, you'll know that I like to keep it quite conversational. So at any point, if you have a question for our panelists, feel free to put your hand up and we'll get a microphone over to you. So I guess to kick things off, gold has, recently reached record highs in March and April of this year. So to kick off this panel, I thought, do we see these strong prices continuing to prevail throughout 2024? What are your thoughts on where the pricing is going to go? I'm gonna start with Alison because she's.
I don't have a particularly strong view that gold will necessarily move higher from here. I think there's a likelihood it could consolidate around current levels. Maybe see prices a little higher and then pull back a little lower and kind of around these levels and thereabouts. But I think it's worth saying that these are very good levels, and for gold mining companies, they're levels that are extremely profitable.
We have a slightly different view. We think both gold and especially silver are going much, much higher from these levels. Very quickly, without getting too technical, the last few spikes up in gold over the last few years have been driven by futures speculators taking the price up, and with the metal following up behind. This time it's different. It hasn't been futures driven by speculators. It's been driven by the bullion price with the futures covering up. This buying has been driven by central banks in Asia buying physical gold in gargantuan amounts. Basically, China running down its holdings in US Treasury bonds. There's still 800 billion left in the Treasury bonds, and they're going to run the whole lot down to zero ahead of anything they do in Taiwan.
Yeah, to add to Ian's point, we've seen a very strong gold price from Asian buying, as Ian's highlighted, in an environment of increasing rates in the US and around the world. Typically in an environment of increasing rates, you see, gold prices coming off. So I think we could actually be in a situation where we have a new floor, and as rates start to come off in the US and the Western buyer starts to come into the market, we could see, prices go much higher, as Ian was highlighting, when that buyer does return.
I would agree also with Ian and Luke. And just to add another, I'm sorry. So we agree. We think also that gold is moving significantly higher to 2,500. And what I would add to the commentary by my colleagues is that so far for the last year and a half, we have seen central bank buying, particularly from the Asian or emerging economies of the East. Now, and at the same time, we have seen the ETF-backed holdings drop to significant lows, perhaps 3-year lows now. Now, the ETF-backed holdings are the preferred instrument for financial investors to gain exposure to gold as a safe haven. So when the narrative changes and those investors are seeking to increase their allocation to gold, they will come back into the ETFs, and that will provide additional physical buying into gold bullion and therefore support the price higher.
Well, I hate to say it, but I agree with everybody but Alison in that we're also seeing a trickle-down effect with the retail market. It's been a fantastic scene to see, actually, in the U.S. The big box Costco is selling $200 million worth of gold bars every month. It's a phenomenon. Every time I go there, I'm buying my toilet paper and paper towels. I'm trying to buy a gold bar, and they're sold out. So that trickle-down effect is happening. It's also happening in China with jewelry. And I don't think $3,000 gold is going to be healthy for us, because I think that tells a lot more about the world that we sit in currently. But certainly between 25 and 28 would be fantastic to see.
All right, great. So you started to touch on the central bank purchasing of gold, which has really, had a significant impact on the market over the past few years. So do you see that continuing? Is it really as impactful as markets or the news has been saying?
Well, I think it was driven. The Chinese move into gold was driven when the Americans and the Europeans started making noises about confiscating the $300 billion worth of Russian assets in Euroclear. And the Chinese and other Asian central banks have looked at this and think, well, if we fall out with the United States over the next few years, maybe they might confiscate our assets as well. So it's not an investment thing. It's a return of my money is more important than the return on my money. And the Chinese saw this, and then they started running down their holdings of treasuries and switching it into gold, taking the gold, shipping it back to Shanghai, where it can't be confiscated. And I think that's what's driving it. And they got another 800 billion sitting there in treasuries that they'll probably run. They're not selling them in the market. They just wait for the bonds to mature, and then they take the redemption proceeds. They don't reinvest them back in the treasury market. They reinvest it back in the gold market. There's a lot more to do.
Yes, I would concur again, but another element that I see as supporting central bank buying, particularly from those regions, is the extraordinary strength of the US dollar, which has become the safe haven currency of the world in the current geopolitical instability. And the view, the realization that the US debt levels now are reaching the post-Second World War levels. Now, if you were to compare in credit analysis terms to a corporate, and you were to look at the gross revenues as opposed to the debt on the balance sheet of a company, I think bankers would raise a great big red flag if that debt exceeds the gross revenues of any corporate. Something similar is happening to the US at the moment, and there are questions as to the sustainability of this increased Treasury bill issuance by the US. And even Jay Powell, the head of the Fed, admitted a couple of months ago that the US is on an unsustainable fiscal path. So that's a big elephant in the room, that if those Asian nations, which have been traditionally for the last 20 years, the natural buyers for US Treasuries, slow down, I'm not suggesting they're going to stop, but if they slow down their purchase of US Treasuries, who is going to buy all that paper?
Just one, sorry to
Go ahead.
take too much time. What Janet Yellen is doing at the moment, they've got a 1.7 trillion budget deficit. And people think, there's going to be a glut of bonds onto the market. Not necessarily, because there's $7 trillion in money market funds. So they're skewing ahead of the election. They're skewing all the issuance in the bill market. which is effectively monetizing the debt and starving the long bonds of bonds. So they're trying to get long rates down. But it's all a pre-election scam. And what Angelos refers to probably won't kick in till after the election. But pre the election, Janet Yellen is monkeying around with the issuance and financing it all in the bill market, which is dead easy because there's $7 billion sitting in money market accounts. So that it's all been pushed towards the short end ahead of the election.
So maybe we can talk a little bit more about what's happening, maybe both within the U.S. and globally, kind of that macroeconomic environment that's creating this environment for gold.
Well, I guess if we look at the BRICS, for example, I mean, if you look at a lot of the sovereign buying of gold, it has been from the various BRICS countries. And in terms of historically, you look at commodities, you look at, what's been used to trade between those countries, it's all been backed by the U.S. dollar. I think, we've touched on it with Russia and, the ability to trade amongst BRICS countries. They're looking at gold as a backstop for the ability to trade. You can't ultimately print gold. So if you use that as a means of trade between the countries, and I don't think, within the various BRICS countries, there's a trust amongst whether you have rubles or won, whereas if you use gold as ultimately the backing to trade between those countries, and I think that's why we've also seen an acceleration of gold purchasing amongst the BRICS countries.
All right. Before we continue on, do we have any questions from the audience? Anything pressing from what we've just been covering?
Seems to be just about all unanimous about buying gold and being bullish on gold. So who are the sellers of gold?
Well, as Angelos has said, one of the sources was the gold ETF. The Americans have been running down their holdings of gold ETFs, physical gold, and that's where a lot of the Chinese have found their gold to buy.
That's where most of the supply is coming from.
Well, the
Chinese ETFs.
The Chinese have been buying the sell-in, which you asked about. One of the sources of selling is gold ETFs.
Yeah, I mean, we've seen that with, gold in the West. It doesn't provide any yield for investors. So as yields go up and you can get 4 or 5% on Treasury bonds and, 5 to 10% on corporate bonds, inevitably money typically flows out of gold because it's a interest-bearing instrument into those. That's back to the earlier comment where I think we could see a new floor for gold, where in that environment, you'd typically see gold trading down, but it's actually hitting all-time highs. So when interest rates come off and, we see a move back into gold from the ETF buyers and the Western buyer, that could really accelerate the price higher.
Should we be worried when 4.5 experts are bullish on the gold price? It's a frivolous question, but also a more serious question is taking up Ian's point. Just tell us more about your focus on silver, because I know nothing about these things, but you sound sort of a lot of it is geopolitics, in which case I thought gold is better than silver.
Traditionally, and if you have a bull market in precious metals, silver is about twice as volatile as gold. And gold is at an all-time high. The all-time high in silver is $50, so it's some way off its all-time high. So the gold-silver ratio, silver is very undervalued relative to gold. So far, as we've all alluded to, the central bank buying is buying of gold. Central banks don't buy silver, but other buyers who missed out on the rally in gold are now starting to buy silver because it's nowhere near its all-time high, and that's having a knock-on effect on the silver mining shares as well, which both the silver miners are starting to outperform the gold miners, and silver itself is starting to outperform gold. But it's reached a point where it kicks in and it suddenly starts to outperform.
Yes, I would add to that silver is traditionally seen as a cousin of gold, as a safe haven asset, but at the same time, it has a much more important demand from industrial applications than gold. And from the reports we read, particularly from the Silver Institute, the demand for silver has risen dramatically in the last few years, driven by photovoltaics and transition energy production, etc., electric cars, and so forth. and it's projected that in the next 2 years there will be a significant deficit in silver supply to the market. So that's a fundamental driver for silver prices, in addition to the correlation to gold as a safe haven asset.
Yeah, the ratio is still very high. The gold-silver ratio is like 86 to 1.
That's right. And long term, over a 40-year term, is around 66, and it has gone as low as 40. So, the possibility for outperformance is significant.
Okay, so just to kind of move us on to a slightly different topic, because we have a few juniors sitting with us here today, I thought we could talk about kind of investor interest in this end of the market. So, what do you hear from investors, and from the investor perspective, what are you looking for when kind of assessing projects within the precious metals gold space?
Well, I would say that we are a junior mining company, gold and silver, so we're very excited to see gold and silver moving up because, as you were speaking of a deficit with silver coming, I think it's going to be fantastic for us because we'll be in production by that point. So that silver credit will become very important to us. But from the investor standpoint, I still think that they're kind of waiting to see if gold is going to stabilize at this and continue to go up, or dramatically drop off the cliff like we've had the last couple of years of uncertainty. I do think it's going to stabilize or go up. But that being said, it's taking a while for investors to really come down the ladder to the juniors, because we are I always tell people when they ask what I do, we jump off cliffs for a living and try to find the parachute halfway down. It really is the junior mining space. That being said, jurisdiction, good management teams, and great projects. Of course, it seems obvious that that's important, but it really is going to become the cream of the crop as we get to the point where the market is comfortable back in the junior space more than the majors or the producers out there, which is why we're focused on fast-tracking our asset, because we know the value of that process.
I think what's happened over the last while is we've seen quite a big disconnect where what we would expect to happen is that as the gold price rises, the price of gold mining companies rises more. They should be leveraged to the price of gold. And instead, we've had the opposite, where as the gold price kind of moved sideways from 2020 through to the end of 23, gold companies' share prices actually fell. So investors are looking at this and saying, oh, it's not really that safe investing in gold companies. And it makes sense because their costs went up by 30%. So the margins were squeezed quite dramatically. But now as gold sort of hits new highs, those margins are really opening up again. Across the gold sector, average costs are around $1,300 an ounce. So they're now sitting with a margin like $1,100 an ounce margin. Is very healthy. Cash flow generation is looking very good. So you start to see some interest coming back. The majors are free cash flow yielding about 5%, even 10% in some cases. You start to see that as a very attractive asset class, and then hopefully bubble down from there to the juniors. The junior mining sector on the whole has been really pretty brutal. Raising money for projects has been extremely difficult. So you need to kind of get over that hurdle.
I think there's an element that does tie into where the gold buying's been coming from as well. I mean, if we're looking at gold buying, and we've highlighted it here that a lot of it's coming out of China and BRICS countries and out of the East. Well, those typically aren't the investors who are buying gold equities. I mean, the ETF sellers are typically the same buyers who are ultimately looking at buying gold companies. So I think we have seen part of the disconnect is because that, gold equity buyer has been, not coming back to the sector. I think ultimately those margins and those free cash flow yields that are being referred to will bring that investor back. I mean, if we look at the first quarter of this year, the average gold price was around $2,070. If we look at Q2, we're trending towards $23 to $23.50 for the quarter. I mean, the cash flow generation that will drive an extra $300, let's say, in gold price will fall directly to the bottom line for all of the seniors. Typically for the smaller companies, which I think is how you started your question, you need the performance in the larger caps to flow into the mid caps and then into the junior sector. So as the seniors start to trade back up towards 1x NPV, whereas today they're still pretty close to historical lows, that money will start to flow down market. And I think Q2 could be a real driver for that to happen.
If I may add, from our experience, and we speak to a great breadth of investors, from institutional and professional investors specializing in precious metals, investing down to sort of generalist, smaller, I would say, net worth investors. And the narrative we've been hearing for the last couple of years has been the cost inflation. How investors could not really analyze the operations of a mining company, particularly a gold miner, not having seen the impact of inflation in capital goods, in steel, in consumables that are used in the mining process, as well as labor cost inflation. And most companies have been hit very hard, and we have seen some very alarming, warnings or misses of expectations from the producing companies even. So this has kept the greater investment community away from the mining sector, which I have to add is a very narrowly specialized sector. If you think that the global market cap of mining companies is probably less than Apple. Apple's market capitalization on the New York Stock Exchange. So investors have been very scared of the potential corporate failures and kept away from the mining sector as a whole. Now that they're gaining a little bit more confidence that the commodity price increase is expanding the profit margins, and are seeing some very positive reviews and updates, quarterly updates from the miners coming through in the last few weeks, they are gaining more confidence. But again, as Luke pointed out, the confidence starts from the larger caps down to the middle capitalization producers, who are seeing the greater expansion of cash flow, and then it will gradually flow through to the smaller ones. And the other final element I'd like to touch on is the hesitance of the corporate management teams from the well-capitalized mid-cap producers to engage in corporate activity with smaller companies. No manager so far has had the confidence to acquire earlier stage or even development stage assets because they thought they would not be rewarded by the capital markets. Now, in the last 3-4 months alone, we have seen 8 deals happen, and some of them with sort of development stage assets. And that shows that the management teams are now starting to ask the question of growth. How can we grow our reserve life and our mining prospects before the prices really take off and the valuations re-rate? And I expect we will see a lot more corporate activity, and that will drive, again, investor interest to shift down to the smaller cap companies.
I've heard the panel talking. I've now got 4, which is probably quite greedy. One relates to cost. Mark Bristow, when he was running Randgold, he had a figure around 1,200 as his kind of baseline figure for gold, which was a reasonable approximation of marginal cost of production with some kind of return on it. What does the panel think that number is now? Question 1. Bearing in mind that the costs of the miners, there certainly is labour in there, but if you look at how inflation's impacted, particularly more recently, it's labour and services has remained quite high. Goods and fuel and stuff's come back all the way. So, whatever it was, I suspect it's a bit lower than it was 6, 9, 12 months ago in terms of that number. Secondly, relates to the behaviour of large and very large companies in the sector. Having looked at it for 42 years, I came in when the large resource companies, the oil majors with all their cash flow, were spending their ill-gotten gains on buying massively overpriced mining companies. And then I saw mining companies do the same boom. I have this phrase, big ugly mining morons, the bums. If the big companies in the sector are doing something, it's quite a good question, is it completely the wrong thing? And what's disconcerted me amongst the majors, including some very smartly managed companies, is this lust for copper. I mean, these are supposed to be gold mining companies. Why are we buying copper? I mean, you can buy copper other ways. I don't want to buy it through companies like Barrick and Newmont. So if they're doing that, it does question, A, the management judgment of these companies, and B, why you should be buying them as gold miners. For the mid-caps, their problem is management, resource, and attention. And it's like West Africa. Those deals only get done, West Africa only runs when there's a big enough margin of safety between the cost and the price to actually get involved. So that surge from 2 to 2,400 has got people back in the game. If you look at the West Africans, they've gone crazy because you're paid to take the risk. For mid companies, you're paid to get involved now and take on developers and explorers. But do you think that the companies are well enough managed, generally, particularly the big end of town, to merit institutional involvement? I mean, as Angelos said, they're smaller than Apple, they're smaller than your average sort of San Francisco internet florist. I mean, they're a tiny sector. Do they deserve to be bigger, is my question.
I mean, I guess your first question in terms of, all-in sustaining cost and, inflation that we've seen in the sector, without a doubt, over the last 3 years, there's been significant inflation. I mean, if you take Newmont, for example, they were forecasting around $1,000 all-in sustaining costs 3-4 years ago. They're up to $1,300 today. So, the margin compression has been one of the issues that the sector's been facing, and part of the reason why the equities haven't been performing. If we go back and look at, again, Q1 of this year, there's been a lot of talk from the, majors and mid caps about a flattening of costs, and even in some cases, costs starting to go down. So that full extra $300 of gold price appreciation that we're seeing between Q1 and Q2, or looks like, obviously we haven't finished Q2 yet, but on track for $300 of additional gold price, will fall directly to the bottom line. Over the last 3 years, the challenge is costs have been going up in line with gold price. So I think, again, for your first question in terms of costs, I think Q1 has been a good indicator of things starting to finally, normalize and no longer, going up the way we've seen over the last 3 years. On the
On industry-wide kind of marginal cost of production, if it was 1,200, 1,300, what do you think it is now?
I don't have that figure off the top of my head.
It's very hard to assess the global industry-wide average cost or marginal cost of production. But my guess and my indication from reports I see compiling data sheets among big companies or rather large and mid-cap companies, my guess is that it's probably around 1,300, between 1,300 and 1,400. And the other element that brought the costs up has been the high grading emphasis of the last couple of years, when companies were under stress and were keen to expand their profitability or at least keep their operations at a healthy stage. They tended to focus on the higher grade areas of their mines and produce those first, not necessarily safeguarding the longer term viability of their business and the life of mining. And that's why we have seen that from the large companies down to the mid-caps, the great majority have seen the average mining life shorten. And this is why the management teams are now under pressure to add to this reserves mine life. And the only way really to address that quickly is by buying a development stage asset that is ready to go to production. So that's probably answers half of your first and half of the second. I would say in terms of the copper diversification, that's again, I think it's a nature of the pressures of the market on management teams. Shareholders have been battering them down for the last 2 years to return capital and fix their balance sheets, that gold has been a terrible investment and so forth. So we have seen it even from the silver miners. Silver miners have diversified to a great extent into gold. And even some of the before too exclusively focused silver miners have told me, well, we cannot bear the volatility of silver. It is 3 times, as Ian pointed out, more volatile than gold. You cannot run a mining company with that type of volatility on your primary input, on your revenue income. So they are diversifying into gold, and likewise the barracks and the large caps, the mega caps, are diversifying into copper to broaden their balance sheet and their operations portfolio.
Maybe just one thing that I would highlight, which I think is quite interesting as a development, is that in the last few years, normally what you would see is that a new project coming online is, in many cases, lower cost than the average industry project. So you can't say what's the average industry cost, and then that's kind of like what a new project is going to need. A new project might need lower because it's a new discovery, it starts off at the higher grade end of the deposits, and so on. But I think what's quite fascinating is that the new projects that have in fact come on in recent years have not tended to follow that. They have been very jurisdictionally based. So they have been highly concentrated, particularly in North America. And places like West Africa have just not really seen growth in supply at all. And there's perhaps an opportunity there where those kind of lower cost but higher political risk jurisdictions kind of get a turn as well. And we see that impact on the cost curve more globally.
I mean, I think the other point to add is, from an industry perspective, we've had gold above $2,000 now for all of this year and, trading at all-time highs. I mean, the industry is still running reserves at $1,700, $1,800. So there is, an element that it's, backward looking. But, we fast forward 6-12 months from now and we've had an entire year of, let's say, $2,200, $2,300 average gold prices. Well, the industry is going to start to reflect that into the, models that are being used. And that will ultimately have a real positive impact as well. So whether it's reserves, cash flow models, and, that's another thing that will have a positive impact ultimately.
I mean, it's not just the industry that are using maybe what is too low a price on gold and silver. It's also the broking community. A lot of the analysts are still using $18 silver as their base case to work out all the earnings on these companies. Silver's $30 nearly. So the analysts haven't got round to upgrading all their forecasts either. Same with gold, because they don't want to look stupid if it's a spike. They don't want to see it spike up, stay there for a couple of days, and then they have to rework all the sums back down again. So they have a tendency to wait and see if it holds, wait and see if the price sticks, and then they get round to finally upgrading all their forecasts. And then the generalists, rather than the specialists in the sector, tend to rely on the broker research before they, because in this era of extra regulation that fund managers live under at the moment, it's a lot of box ticking and backside covering. So before they buy a company, they can be questioned about, did you do your due diligence on this company? Where's your research? And it's helpful to have a couple of broker circulars that have upgraded that to point to, well, that's why I bought it. So if anything goes wrong, their rear end is covered. There's a lot of that goes on in the industry, a lot more than they used to.
So, how do you change that situation?
Get rid of the regulator, actually.
Okay.
Maybe have a different cost structure for bankers and analysts.
I guess that is the opportunity that we see, and of course we are biased because we are investors in the sector, but that is the opportunity that over time both the analyst community and the investors will upgrade their expectations for profitability and margins as well as reserve replacement, and therefore re-rate the equities of the sector, the equity valuation of the sector.
Sorry, I'd like to know what the fund managers have been doing in terms of their own dealings or trading activity in the last month. What have you been buying and what have you been selling and why?
Trade secrets.
In the last month, nothing. We haven't really been changed the strategy at all. I mean, as you know.
Well, I would say that we have started seeing some inflows. I have to say that they are nascent. I can see still general reluctance of investors. It's a vicious cycle. Investors will start putting capital first into the equities, then the more generalist investors will come into the funds that are diversified, and the funds will feed back into the equities. So what I'm saying is that we have focused on the companies that, at least in the mid-tier sector, that are producing significant cash flow generation, that have a growth profile in the resources and reserves. They have a pipeline of projects that could come up to production in the near term. These are the sweet spot in the market. And then beneath that, we are looking at development stage projects that could be a very, very attractive addition to a mid-cap producer who is looking to extend their reserve mine life, 3 or 4 or 5 years down the line. And this is what the management teams are now, I believe, sharpening their pencils, analyzing those projects that are at NPV, at PEA level, preliminary economic assessment, or even later. And they can see clearly what is the cost of development, how long it's going to take, are there any permitting hurdles, how quickly can this project be brought to production given a stronger balance sheet and a stronger financial backing.
So one of the kind of main talking points, with the big energy transition thematic is kind of understanding gold's role, it's traditionally been quite a safe haven asset. So I thought we could, just change discussion a little bit to talk about kind of the importance and relevance of gold, kind of how it's framed within this new mining kind of thematic overall. And I suppose what the pitch would be for gold and other precious metals.
For me, I think it's not really. I mean, I think just the simple fact of it. Like, I think in many people's minds, or in most people's minds, and indeed in my mind, gold sits kind of
separate.
Yeah, kind of. Like, is gold sustainable? Is using it as a store of value sustainable when you have to expend all that energy to go and get it out the ground and you're not actually going to do anything with it? Well, maybe not. But then the same could be said for, Bitcoin and all the energy it consumes, or, what else are you going to use as a kind of a store of value? So I think for the gold companies, I think what does become important is how, as a company, are you making sure that your footprint is as low carbon intensive as possible. But I think for investors, it's not kind of like a thematic, like, oh, well, this is kind of green transition, so let's go gold. It doesn't kind of have that greenness to it.
I mean, if you look at, say, comparing gold to silver, all the gold that's ever been mined is still probably around. It's either in the vaults of central banks or it's on people's fingers as jewelry. It hasn't really been consumed. It's still there. Whereas silver has been consumed. It's in mobile phones. It's in solar panels. It's in all sorts of things. So there's no. If the price of gold spiked up to, I don't know, $4,000, there could be an enormous amount of sellers in the market of existing holders of gold. Whereas if silver was to spike, there's no readily available stockpile of silver that could come onto the market because central banks don't buy silver. They don't sit there with, and they don't, as pointed out as well, they don't buy silver mining or gold mining companies either. They just buy physical gold. And all the physical gold that have been mined is around as a potential future supply. So there's quite a crucial difference between gold and silver. And that's one of the reasons why, we tend to favor silver over gold, is that you haven't got that potential supply at a price that can suddenly come onto the market.
If I may just make a comment in terms of the relative value of gold and why it has been since antiquity viewed as a value preservation tool or a safe haven asset, I think we have to think that what kind of investors does it appeal to? And it's the type of investors who have surplus capital that they wish to safeguard against monetary and political instability in the world, and they are looking for a great variety of assets to put that capital to use. those kind of criteria, the criteria rather whether gold is actually a useful commodity in the marketplace becomes secondary to the value preservation asset and perhaps hedge against inflation, against monetary and political instability. So an investor might not think whether property is actually more useful to invest in and probably quite stable over the long term than gold, but they are looking for different aspects of gold's attributes as a safe haven asset.
Okay, great. So just being conscious of time, we do have a number of presentations coming up for the rest of the morning. I thought we could just have some closing thoughts from our panelists, just in terms of, outlook both for your companies, for the industry as a whole, and I suppose what you're kind of looking forward to over the coming years for the industry.
I'm actually looking forward to seeing the majors and the mid-tier companies start to investing, trickling down to the junior space, because we're always looking for funding, from equity, type raises, and we really need to be partnering with these bigger groups to invest in the junior space because they need pipelines. And as you've heard on this panel, they've all these majors have been quite scared about making big moves in an uncertain market that we've had the past 2-3 years. But at the end of the day, we are going to have a deficit with silver. We are going to have a deficit with copper. And without the pipeline, we're all going to be in trouble because we all know permitting takes forever for almost any project in the world. And so I think that it really, we really need to start partnering with these big companies, as well as when you're looking at lithium and copper and companies like this, they should be looking at partnering with the Teslas of the world. There is some of that, but we need more of that within industries that can build projects and advance them quicker through the process. So I'm looking forward to more M&A in this space. There's lots of talking, but there's not a lot of moving. I mean, yes, we've seen a little bit recently, but not enough of it. And consolidation is really key in areas where maybe there's a geopolitical risk that freaks people out. But if you had a Barrick come in and partner with you, it gives that certainty to the market to move both companies forward.
I think really the thing that maybe kind of a sort of this year and then kind of longer term. I mean, for me, I think this year is all about the gold equities actually catching up to the price. There's a lag, and we've seen this before. Look at 2019, very similar. The gold stocks hadn't been performing; they were way under the gold price itself, and then there was a massive catch up. So that's what kind of my aspiration for this year, rather than as I started with, really too much on the gold price. I think longer term, the trend that we are going to be watching and really just looking out for to see how far it goes is how far that safe haven /currency /central bank or reserve theme of gold really plays out. You've had the BRICS talking about potentially a gold-backed currency that they will use amongst themselves in the future. That's not something that happens this year. That's kind of a decade. But it's an interesting theme and something that we're going to be really watching out.
Yeah, I mean, if you go back a couple of months ago, gold was hitting a new all-time high, and Newmont Mining, which is the granddaddy of the sector, was hitting a 5-year low. And then that's never been seen before, I don't think. And if Newmont was hitting a new low, the bigger silver miners were hitting an even bigger low, and the junior gold miners and silver miners were even hitting much bigger low. So this sector has got completely bombed out. It's lost touch with where the metal prices are. So there's two sides of the coin. One, investors look at it and think, this sector's a disaster. I don't want any of my money anywhere near it. And another investor might like, hey, these things are so cheap that I've just got to load up the truck here because there's an anomaly and you can't have gold and silver keep going up and the mining shares keep going down. Something's got to give. Either the gold and silver price has got to come back down, which looks unlikely. It looks a lot more likely that these mining shares have to catch up. And so we would be in the camp that actually don't be put off by the previous 2 or 3 years' performance. Don't be scared by it. View the bombed out valuation levels as an opportunity to make quite a bit of money. That would be our take.
Yes, I would agree. And looking at the long-term development of markets, we all know that when sentiment swings widely from one side, from positive to negative, the markets tend to overshoot dramatically in either direction. So we believe that we have greatly overshot to the downside over the last couple of years. And there is the significant potential now that not only we will swing back to the long-term medium, but we will actually overshoot the other way. And that will obviously be a function of the commodity price retaining the current level and possibly trending higher. But once this confirmation comes from the price development, the potential shift in sentiment and the rush by the generalist investors to increase their allocation, not only to gold, but also to mining equities, could provide a massive re-rating and overshooting the other way.
Yeah, I guess for Newcore specifically, I guess we're talking about leverage to the gold price, and we just put out a PEA a couple weeks ago, and looking at every $100 move in the gold price adds more than the market cap of Newcore today. So the leverage to the gold price on the upside is huge for companies like ours, Newcore. And you look at it at 23.50, you're all of a sudden looking at an after-tax NPV of 630 million, after-tax IRR of 92%, and just over a 1-year payback. So the leverage to the gold price is has a huge impact for development stage companies as well. We've obviously talked about the impact it'll have for the seniors, an extra $300 a margin, and how that falls directly to the bottom line. And then I think that's ultimately what draws that generalist investor back into the market. I mean, they're looking for price earnings, they're looking for free cash flow yields. Those are the types of metrics that the generalist investor is ultimately looking for. And with a $2,300 gold price, there's no way they'll be able to not look at the gold sector given the yields and the price earning ratios that these companies are and will be trading on if we see that persist through Q2.
All right, great. Certainly quite a bit to consider as we kind of take this information out. But that does bring us to the end of the panel. So I want to thank all of my panelists for joining me here today for, I would say, the most lively discussion of one-to-one London this year. So thank you.